Owner financing, also known as seller financing or seller carryback, is a creative alternative to traditional mortgage financing. You might have heard of this before and thought it was information for buyers, but now that we've seen the mortgage interest rate move higher, seller financing is an option that is putting money in the pockets of sellers who have low mortgage interest rates. So yeah, creative financing is always an important tool for buyers, but today, sellers should educate themselves too, as opportunities exist for them as well. In owner financing, the homeowner acts as the lender, allowing the buyer to pay them directly. This arrangement can benefit both parties, offering unique advantages and flexibility. In this video, we'll explore how homeowners can offer financing to buyers, expanding their options and making home ownership more accessible and profitable. Creative financing is essential for real estate investors because it provides alternative methods to fund and acquire properties beyond traditional bank financing. Here are 6 reasons why creative financing is important for real estate investors. Increased deal opportunities. Creative financing opens up a broader range of investor opportunities. It allows them to explore deals that might not be feasible or accessible through conventional financing options. This flexibility enables investors to find unique properties, negotiate favorable terms, and seize opportunities that align with their investment strategies. Overcoming financing obstacles. Creative financing can help investors overcome financing obstacles, especially when they don't meet the strict criteria of traditional lenders. Investors with limited credit history, insufficient down payment, or unconventional income sources can still find ways to fund their real estate transactions through creative financing options. Flexible terms and structures. Creative financing provides flexibility in terms of structure, allowing investors to tailor financing arrangements to suit their specific needs. They can negotiate favorable interest rates, repayment schedules, and other terms that align with their investment goals. This flexibility fosters more innovative and customized financing solutions that benefit buyers and sellers. Higher return on investment, that's ROI. By leveraging creative financing strategies, investors can potentially achieve higher returns on their investments. For example, techniques like seller financing or lease options can enable investors to secure properties with little to no money down, thereby maximizing their ROI. Creative financing empowers investors to structure deals in ways that optimize cash flow and profitability. Diversification of funding sources. Relying solely on traditional bank financing can limit an investor's options and expose them to potential funding constraints. Creative financing allows investors to diversify their funding sources by tapping into private lenders, partnerships, crowdfunding platforms, and other non-traditional avenues. This diversification reduces dependence on a single source of financing and enhances financial resilience. Increased negotiation power. When investors can offer creative financing solutions to sellers, it enhances their negotiation power. Sellers may be more inclined to accept offers with favorable financing terms, even if the purchase price is lower than competing offers. This advantage allows investors to secure properties at better prices and terms, leading to improved investment outcomes. Remember, any benefit to a buyer becomes a potential benefit to the seller, as the more buyers interested in the home, the better price and terms the seller can get in a sale. So these are the key reasons why sellers, buyers, and real estate investors should educate themselves on creative financing. It empowers real estate investors by expanding their opportunities, overcoming financing obstacles, providing flexibility, enhancing ROI, diversifying funding sources, and strengthening negotiation power. Creative financing enables investors to navigate the real estate market, unlock potential deals, and optimize their investment strategies. If you're a longtime subscriber, then you know I often use viewer questions for my new videos because you guys keep our channel heading in the right direction with timely and important topics. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype that is so prevalent online, then subscribe now and I'll keep you in the know. The first type of seller financing to consider is an installment sale, where the homeowner agrees to sell the property to the buyer and accepts payment in installments over an agreed-upon period. The buyer takes immediate possession of the property but makes regular payments to the seller, which typically includes both principal and interest. An installment sale, also known as seller financing, Contract for deed or land contract is a financing arrangement in real estate where the seller acts as the lender and the buyer makes payments directly to the seller over a specified period of time. Here's how it works and the benefit it offers to both buyers and sellers. Buyer and seller enter into a purchase agreement outlining the terms of the installment sale, including the purchase price, down payment, interest rate, payment schedule, and duration of the agreement. Financing. Instead of obtaining a loan from a traditional lender, the buyer makes regular payments directly to the seller over an agreed-upon period. The seller retains legal ownership of the property until the buyer completes all payments. In the title transfer, once the buyer fulfills their payment obligations, the seller transfers the title and ownership of the property to the buyer. Let's look at the benefits for the buyer. Easier financing. Buyers who face challenges obtaining traditional financing, such as low credit score or insufficient down payment, may find it easier to secure an installment sale. Sellers often have more flexible eligibility criteria and may be more willing to work with buyers who don't qualify for conventional loans. Lower closing costs. An installment sale may involve lower closing costs since it eliminates or reduces the need for loan origination fees, appraisal fees, and other charges associated with traditional financing. Flexible terms. Buyers and sellers have more flexibility to negotiate terms in an installment sale. They can customize the down payment amount, interest rate, and payment schedule to suit their specific needs and financial situations. Opportunity for ownership. Buyers can start building equity and gain ownership rights while making installment payments. This can be particularly advantageous for individuals who want to invest in real estate but have limited funds for a large upfront payment. Now, let's look at the benefits for sellers. Can attract more buyers. Offering seller financing expands the pool of potential buyers as it attracts individuals who may not qualify for traditional loans. This increased buyer demand can help sellers negotiate higher prices with all parties and sell the properties more quickly. Steady income stream. Sellers receive regular payments from the buyer, creating a predictable income stream. This can be beneficial, especially if the seller doesn't need the entire sales proceeds up front or prefers consistent cash flow over time. Potential for higher sales price. By offering installment sales, sellers may have the opportunity to negotiate a higher purchase price or charge a higher interest rate than they would in a traditional sale. This can potentially increase their overall return on investment. Flexible exit strategy. If the seller does not need the full sale proceeds, an installment sale allows them to defer some tax obligations and potentially spread out their tax liabilities over the installment payments. In summary, an installment sale in real estate provides an alternative financing option where the seller acts as the lender. It benefits buyers by offering easier financing, lower closing costs, flexibility in terms, and an opportunity for ownership. Sellers benefit from attracting more buyers, steady income, the potential for a higher sales price, and a flexible exit strategy. Overall, an installment sale can be a win-win solution for both parties involved in a real estate transaction. In a lease option arrangement, the homeowner leases the parties to the buyer with an option to purchase it within a specified time frame. A portion of the monthly lease payment can be credited towards the purchase price if the buyer exercises the option. This allows the buyer to rent the property while building equity towards home ownership. Similar to a lease option, a lease purchase agreement combines a lease and a purchase agreement. The buyer agrees to purchase the property at the end of the lease term, and a portion of the monthly rent is applied towards the purchase price. Unlike a lease option, the buyer is generally obligated to complete the purchase. Both a lease option and a lease purchase sale are rent-to-own real estate arrangements that combine elements of a lease agreement with the potential for a future property purchase. While they share similarities, there are some differences in how they work and the benefits they offer to buyers and sellers. So let's start with a lease option. A lease option, also is known as a rent-to-own agreement, provides the tenant or a buyer with the option to purchase the property at a predetermined price within a specified period. Here's how it typically works. The agreement. The landlord seller and the tenant buyer enter into a lease agreement that includes an option agreement. Option agreement grants the tenant buyer the exclusive right to purchase the property during the option period. Rent and option payment. The tenant buyer pays the landlord seller a monthly rent, typically higher than the market rent and an upfront option fee or option consideration, which serves as a non-refundable payment for the right to purchase the property. As far as the period, the lease agreement specifies the option period's duration, typically 1 to 3 years. During this time, the tenant buyer has the opportunity to improve their credit score, save for a down payment, or assess the property further before committing to purchase. And as far as the purchase decision, at any point during the option period, the tenant buyer can exercise the option to purchase the property. If they decide not to exercise the option, the landlord seller retains the option fee and the property remains with the seller. Let's look at the benefits for the buyer. Path to home ownership. Lease options allow buyers to live in the property they intend to purchase while they prepare for home ownership. Time for financial preparation. Buyers can use the option period to improve their credit score, save for a down payment, or resolve any financial issues that might prevent them from securing traditional financing. Test property and location. Renting the property allows buyers to experience living in the neighborhood and test the property's suitability before committing to the purchase. Let's look at the benefits for the sellers. Income generation. Sellers receive rental income throughout the lease period, including higher rent due to the option fee and potential rent credits if agreed upon. Higher sales price. The predetermined purchase price in the option agreement may be higher than the current market value, allowing sellers to sell the property at an increased future price. There's a wider pool of buyers. Lease options attract buyers who may not qualify for traditional financing, expanding the potential buyer pool and increasing the chances of finding a suitable purchaser. A lease purchase sale, sometimes called an installment land contract, is a contract where the tenant buyer agrees to purchase the property at the end of a specified lease term. Here's generally how it works. The landlord seller and the tenant buyer enter into a lease agreement with a purchase agreement attached. The purchase agreement outlines the terms of eventual property purchase, rent and down payment. The tenant buyer pays monthly rent, which may be higher than market rent, and typically makes an upfront down payment or deposit towards the future purchase of the property. And as far as purchase obligation, unlike a lease option, the tenant buyer is usually obligated to purchase the property at the end of the lease term. Failure to do so may result in forfeiting the down payment and potential legal consequences. In the title transfer, once the tenant buyer fulfills their obligations, such as completing the lease term and securing necessary financing, the property ownership is transferred from the seller to the buyer. Now let's look at the benefits for the buyers. Home ownership commitment. Lease purchase agreements provide a clear commitment to purchase the property, allowing buyers to work towards home ownership with certainty. Time for financial preparation. Similar to lease options, buyers can use the lease term to improve their credit, save for a down payment, or address any financial concerns before finalizing the purchase. Now, let's look at the benefits for the sellers. Guaranteed sale. Sellers have a higher level of certainty that the property will be sold since the buyer is typically obligated to purchase at the end of the lease term. Income generation. Sellers receive rental income throughout the lease period and may benefit from a higher rent due to the tenant's commitment to purchase. It's worth noting that the specific terms and conditions of lease options and lease purchase sales can vary, so it's essential for both parties to thoroughly review and understand the agreements before entering into such arrangements. Consulting with a real estate attorney or professional can provide further guidance and ensure local laws and regulation compliance. In a wraparound mortgage, the seller extends a new loan to the buyer while still being responsible for the existing mortgage. The buyer makes mortgage payments to the seller, who in turn continues making payments on the original mortgage. This allows the buyer to acquire the property without obtaining new financing or qualifying for a new traditional mortgage. A wraparound mortgage, also known as an all-inclusive mortgage or wrap loan, is a financing arrangement in real estate where a new mortgage is created that encompasses an existing mortgage. This type of mortgage can benefit both buyers and sellers in the following ways. From the buyer's perspective, it's simplified financing. A wraparound mortgage allows the buyer to obtain financing without having to secure a traditional mortgage from a lending institution. It provides an alternative option for buyers who may have difficulty qualifying for a new loan. Flexibility in down payment. Buyers can negotiate the down payment and terms directly with the seller, offering potential flexibility in structuring the financial terms of the transaction. Avoidance of conventional financing. If the buyer has an existing mortgage or faces challenges in obtaining conventional financing, a wraparound mortgage provides an alternative path to home ownership. And from the seller's perspective, enhanced marketability. By offering a wraparound mortgage, sellers can attract a broader pool of potential buyers who may not qualify for traditional financing. This expanded buyer base increases the chances of selling the property promptly. A higher sales price. Sellers can potentially sell the property at a higher price since they are providing financing to the buyer. The agreed upon sales price typically includes the outstanding balance on the existing mortgage plus any additional financing provided by the seller. Ongoing income stream. Sellers receive interest payments from the buyer on wraparound mortgages, allowing them to earn ongoing income during the term of the wrap loan. This can be especially advantageous if the seller has a very low interest rate on the existing mortgage on the property. So how does a wraparound mortgage work? The buyer and the seller agree upon the terms and conditions of the wraparound mortgage, including the sales price, interest rate, payment schedule, and other relevant details. The wraparound mortgage creation is a new mortgage is created that includes the balance of the existing mortgage and the additional financing provided by the seller. In payments, the buyer makes regular monthly payments to the seller, who in turn continues to make the payments on the existing mortgage, if applicable, while retaining the difference as income. And property ownership. The buyer gains legal ownership of the property and receives equitable title, while the seller holds the original mortgage and has a security interest in the property until the wraparound mortgage is paid in full. And then there's risk considerations. Both parties should be aware of the risks involved. If the buyer defaults on the wraparound mortgage, the seller may face challenges in foreclosing and reclaiming the property if there is still an outstanding mortgage on it. It is crucial to have a well-drafted agreement that addresses default and foreclosure proceedings. Both parties should seek a legal opinion on how the existing loan's due on sale clause might come into play. It's important for both buyers and sellers to consult with a real estate attorney or legal professional to ensure compliance with local laws, properly structure the wraparound mortgage agreement, and protect their interest throughout the transaction. Subject to financing involves the buyer taking over the seller's existing mortgage payments without formally assuming the loan. The buyer gains control of the property while the seller's name remains on the mortgage. The buyer is responsible for making payments, but the loan and the liability for its satisfaction remain in the seller's name. Subject to financing, also known as subject to mortgage or subject to deal, is a real estate financing agreement where the buyer acquires a property while taking over the existing mortgage payments without formally assuming the mortgage. Subject to financing can benefit both buyers and sellers in the following ways. And from the buyer's perspective, no new loan qualification. Buyers who may have difficulty qualifying for a traditional mortgage can acquire a property without having to secure new financing. This can be beneficial for buyers with less than perfect credit or limited financial resources, and they get favorable financing terms. Buyers can potentially benefit from the existing mortgage terms, such as low mortgage interest rate or a longer repayment period, which can result in lower monthly payments and an overall cost savings. And they get faster acquisition. Subject to financing allows buyers to acquire a property quickly without going through the time-consuming process of securing a new loan. This can be advantageous in competitive real estate markets. And from the seller's perspective, they can get a fast sale. Sellers can sell their property quickly by transferring the ownership to a buyer who takes over the existing mortgage. This eliminates the need for the seller to wait for a buyer to secure new financing, streamlining the sales process. And avoidance of cost. Sellers can avoid paying prepayment penalties, loan assumption fees, or other costs associated with paying off or refinancing the existing mortgage. Reduce liability. Sellers transfer responsibility for making mortgage payments to the buyer, thereby reducing their ongoing financial and legal obligations related to the property. Here's how subject to financing works. The buyer and seller agree on the terms and conditions of the subject to financing arrangement, including the purchase price, transfer of ownership, and the terms of taking over the existing mortgage. As far as due diligence, the buyer conducts thorough due diligence to assess the existing mortgage, ensuring it is in good standing, reviewing the loan terms, and confirming that the seller is up to date on mortgage payments. And then the property transfer. The seller transferred the property's ownership to the buyer through a legal process, typically involving a deed transfer. The existing mortgage remains in the seller's name, but the buyer gains equitable interest in the property. And for mortgage payments, the buyer assumes responsibility for making the mortgage payments directly to the lender. The seller may no longer have any involvement in the property's mortgage, but they may still retain legal liability. And then there's risk considerations. Both parties should be aware of the risks involved. If the buyer defaults on the mortgage payments, the seller may still be legally liable, potentially resulting in a credit damage or foreclosure proceedings. Clear communication and trust between the buyer and seller are essential. It is crucial for both buyers and sellers to consult with a real estate attorney or professional to ensure compliance with local laws, protect their interests, and mitigate potential risks associated with subject to financing. Additionally, it's essential to review the existing mortgage documents to verify any potential risks or limitations imposed by the lender. And then there's seller-assisted down payment. With a seller-assisted down payment, the seller agrees to assist the buyer with the down payment required for traditional mortgages. The seller may provide a loan or gift funds to the buyer, reducing the initial cash requirement and making it easier for the buyer to qualify for a mortgage. A seller-assisted down payment, also known as seller financing or seller contribution, is a real estate arrangement where the seller of a property provides financial assistance to the buyer by contributing toward the buyer's down payment. Here's how it typically works and the benefits it offers to both buyers and sellers. The buyer and seller agree on the terms of the seller-assisted down payment arrangements as part of the overall purchase agreement. The specific details, such as the amount of the down payment assistance and repayment terms, are negotiated between the parties. As far as the down payment assistance, the seller provides a portion of the funds required for the down payment. This contribution can help the buyer bridge the gap between their available funds and the required down payment amount. For example, if the down payment is $20,000 and the seller contributes $5,000, the buyer only needs to come up with $15,000. And as far as structure, the structure of the seller-assisted down payment can vary. It can be a direct contribution by the seller, a loan provided by the seller, or a combination of both. In some cases, the seller may place a second mortgage on the property, allowing the buyer to repay the down payment assistance over time. Let's look at the benefits for buyers. Increased affordability. Seller-assisted down payment programs can make home ownership more accessible, particularly for buyers who have difficulty saving a large down payment. There's reduced upfront costs. By receiving financial assistance from the seller, buyers can minimize their out-of-pocket expenses at the time of purchase, making it easier to manage the initial financial burden. Let's look at the benefits for sellers. Attracting buyers. Offering a seller-assisted down payment can make a property more appealing to potential buyers, especially those who may have limited funds for a traditional down payment. You can get a faster sale. Providing down payment assistance may attract a larger pool of interested buyers, potentially leading to a quicker sale and reducing the time the property spends on the market. Interest earnings. If the seller provides a loan for the down payment assistance, they can earn interest on the amount they lend, generating additional income from the transaction. It's important to note that seller-assisted down payment arrangements involve legal and financial considerations. Both parties should consult with real estate professionals, such as attorneys or agents, to ensure that the arrangement complies with applicable laws and protects the interests of both the buyer and the seller. And then there's other considerations for seller-assisted down payments. Seller-assisted down payment programs, where the seller contributes to the buyer's down payment, are not typically offered by banks or mortgage companies as part of their standard loan products. However, there are alternative options that may allow for seller-assisted down payment arrangements. On FHA loans, the Federal Housing Administration allows sellers to contribute up to 6% of the home sales price towards the buyer's closing costs, prepaid expenses, and discount points. While this contribution is not specifically designated for down payment assistance, it can indirectly reduce the buyer's out-of-pocket expenses, including the down payment. Then on conventional loans, conventional mortgage programs generally do not allow direct seller-assisted down payment contributions. However, some conventional loans allow for down payment assistance through eligible nonprofit organizations or government entities. These programs provide grants or second mortgages that can be used to cover all or part of the down payment. And there's some state and local programs. Various state and local housing agencies offer down payment assistance programs that may involve seller contributions. These programs are designed to assist low to moderate income home buyers and often have specific eligibility criteria. They may provide grants, forgivable loans, or silent second mortgages to cover a portion of the down payment. It's important to note that the availability and terms of seller-assisted down payment programs can vary depending on the lender, location, and specific loan product. It's recommended that potential home buyers consult with mortgage lenders, local housing agencies, or nonprofit organizations that specialize in down payment assistance to explore available options and determine the eligibility criteria. Additionally, when considering seller-assisted down payment arrangements, it's crucial to consult with a real estate attorney or professional to ensure compliance with relevant laws and regulations and to protect the interests of both the buyer and the seller in the transaction. A balloon payment occurs when the buyer agrees to make regular monthly payments for a specific period, typically several years, with a large lump sum payment due at the end of the term. This approach allows the buyer to benefit from lower monthly payments while preparing for the final payment, which can be easily accomplished by the buyer taking out a new bank loan or refinancing. In real estate, a balloon payment refers to a lump sum payment due at the end of a specific period, typically after the shorter-term loan or financing arrangement. Here's how it works and the benefit it offers to both buyers and sellers alike. When a buyer obtains a loan with a balloon payment, they typically make regular monthly payments based on a predetermined repayment schedule. However, instead of fully amortizing the loan over the loan term, a remaining balance, known as the balloon payment, becomes due at the end. Lower monthly payments. One benefit for buyers is that balloon payment loans often come with lower monthly payments compared to traditional long-term mortgages. This can make the property more affordable during the initial loan term, allowing buyers to allocate their funds elsewhere. And then there's the repayment options. Prior to the balloon payment becoming due, buyers have various options to address the outstanding balance. They can choose to refinance the loan, sell the property and use the proceeds to pay off the balloon payment, or pay it off with the personal funds or other financial sources. Let's look at the benefits for sellers. Sellers may offer balloon payment financing to attract buyers who may not qualify for traditional mortgage financing due to credit or income limitations. It can expand the pool of potential buyers and facilitate a higher price or a quicker sale. Additionally, sellers may benefit from receiving interest income on the loan during the loan term, potentially earning a higher return compared to other investment options. Considerations and risks. Both buyers and sellers should carefully consider the risks associated with balloon payment loans. Buyers need to ensure that they have the plan to address the balloon payment when it becomes due, such as securing refinancing or building up sufficient savings. Sellers need to evaluate the credit worthiness and financial stability of the buyer before agreeing to a balloon payment arrangement. It's essential for both buyers and sellers to thoroughly understand the terms and implications of a balloon payment loan. Consulting with real estate professionals and financial advisors is highly recommended to assess the feasibility and potential risks associated with this type of financing. Owner financing offers buyers alternative paths to home ownership while allowing sellers to sell their properties more creatively. In today's housing market, many homeowners are sitting on mortgages with interest rates below 4%. So creative financing solutions might help them increase the amount of money they get from selling their homes. In essence, a low interest rate loan is an asset that adds value to the home if the seller knows how to use it. For savvy real estate investors, owner financing can be a tool used to increase ROI or reduce the amount of capital required in an acquisition. While not every transaction will have sellers willing to offer creative financing solutions, the prudent investor can use owner financing solutions to entice sellers to take their offers. The various owner financing methods provide flexibility and options tailored to the specific needs and circumstances of both buyers and sellers. Before entering into any owner financing agreement, it is crucial for both parties to consult with legal and financial professionals to ensure compliance with local regulations and to protect their interests. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box in the top left corner of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.